Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. I hope everybody is doing well and in good health. Today our topic of discussion is adjusting entries. So before to talk in detail about adjusting entries, anybody who is joining us here in this lecture must know some basics of financial accounting, like accounting equation and the rules of debit and credit, right? And also the general journal entries. Why? Because this topic is a little bit advanced and is not for the beginners. So dear students, what are adjusting entries? Adjusting entries or accounting journal entries that convert a company's accounting records to the accrual basis of accounting. Okay, dear students, you should know what is accrual basis. Okay, in general we have two bases of accounting. One is cash basis and accrual basis of accounting. Under cash basis of accounting, businesses do not have credit transactions, right? So all transactions in all financial events and dealings, they are on cash. But in accrual basis of accounting, businesses may have credit and cash transactions. For example, if you have a business and you can sell an account and you can purchase an account, it means you are following accrual basis of accounting. So here you are learning that how adjusting entries convert the accounting records into the accrual basis of accounting. So let me explain it. Just look here. For example, we have an accounting period of 1 month starting from January 1st and ending at January 31st, and another accounting period is ending at February 28th. Look here, dear students. In our example, we assume we have accounting period of 1 month. So what is accounting period? Simply a period which is covered by the income statement, right? How long after your business is preparing the income statement? So if you are preparing it at the end of each month, then we say the accounting period is 1 month. And if you are preparing it at the end of each 3 months, then the accounting period is 3 months. So simply the duration of the accounting period is depending on your financial statements or the income statement in particular. Okay. So for example, we have accounting period starting from January 1st and ending at January 31st, right? What does this mean? It means that we are preparing the income statement we are preparing the income statement at January 31st. It means we measure our profit and losses at the end of January 31st and also at the end of February 28th. Why? So look here. For example, we are preparing our profit and losses statement or the income statement here at the end of January 1st. Okay, how? It means if we have revenues here and also expenses here, right? Then we are computing the income statement where there are two things, revenues and expenses. So keep in mind, adjusting entries can help us to record the revenues and expenses of this first period, which is January, at the January 31st. It means you should not record the revenues and expenses of one period in another period, right? Irrespective of the payment of the cash, whether you have paid the cash or you have received the cash. We have one principle in accounting by the name of matching principle, and that principle is suggesting that the revenues and the expenses of one accounting period must be matched. So what is meant by matching? Look here. For example, we have revenues, we have expenses here in this period, right? And we also have revenues. Look, so expenses are incurred in a business for the purpose of generating the revenues. So you have incurred expenses here, so the revenues generated by the help of those expenses must also be recorded here in the same period. It means you cannot record the revenues mistakenly here in this period. So to make this sure, right, and to avoid this problem, the adjusting entries can help us. It means at the end of January 31st, you have to make sure if there are expenses of the accounting period which incurred but they have not yet been paid, then you have to record it here before to shift into another accounting period, simply. So that is what we mean by the matching principle. So if the revenues, so if the expenses recorded in one accounting period, for example in January, and the revenues generated by the help of those expenses recorded in the February, it means it is wrong. Why? The reason behind, simple. So if you are recording expenses here, right, and the revenues which should be recorded also here in this period, you are mistakenly recording here, it means you are overstating the revenues in one period and understating the revenues in another periods. So what's the problem with this? The problem is that if you show the expenses higher in one accounting period, it means you are lowering the income there, and that is not the realistic picture. You should try to show the correct performance of each and every particular period. For example, when you make the income statements and the expenses shown not correctly in that income statement, so that is telling you that the performance of that period is also not realistic and correct. So that will mislead the stakeholders. Who are stakeholders? The managers and the shareholders, right? And anybody who is reading the financial reports will be misled by this information, okay? So that is why under adjusting entries, we try to record the revenues and the expenses of each period. For example, the revenue and expenses of the January at January 31st, and the revenues and the expenses of February at February 28, right? And this is the purpose of adjusting entries. So dear students, we have 4 types of adjusting entries, and inshallah we will discuss each and every type in detail with numerical exercises. So look here. Okay, dear students, the first one we have, that is converting assets to expenses, right? Here you learn how by the help of adjusting entries we are converting assets to expenses and then converting liabilities to the revenues. This is the second one. And the third one is to record unrecorded expenses. And the fourth is to record unrecorded revenues. So try not to be confused. We will discuss one by one, each one in detail with example, okay? So let's come here. Dear students, the first type of adjusting entries we have is entries to apportion recorded cost and converting assets to expenses. So we have assets, right, and expenses. So look here, dear students. For example, if you have fixed asset in your business like land, building, computers, equipments, furnitures, right? And also we have some current assets like supplies and prepaid expenses. So all these expenses gradually decreases its value or its useful life. For example, you have a furniture and it may have a useful life of 10 years. So when you use it, it is depreciated. So the gradual decrease in the value of an asset or a fixed asset or its useful life is called depreciation. And that depreciation is the expense, right? So we say when we invest in our fixed assets, that is the advance payment for the future services. So all fixed assets gradually, except the land, okay, the land is not depreciated. All the fixed assets gradually decreases its value. So the decrease in their value, we call it what? Depreciation. So that's why you have to make sure at the end of accounting period, if there are some fixed assets that decrease their values, right, then you have to record them as an expenses of that period, right? So much simple and easy. Similarly, if we have some current asset like supplies, you have purchased supplies and during accounting period some portion of your supplies used, so we say the used portion is converted into expense. We treat it like expense. So what is expense? Whenever we receive the benefit of the assets. So the assets, when is used, that is decreasing the value, in exchange that is giving us some benefits, right? So the value which is decreased for generating the benefit, that decreased value is actually called expenses, okay? So in our example here we have January 1st supplies purchase for cash $1,200. So dear students, what purchase here? Supplies for cash, and how much is the value? $1,200. So how we can record this transaction? Look here, supplies debited, right, and cash should be credited. How much? $1,200, and cash should be credited $1,200. Why? Because supplies, that is our current assets, increased, so we debited, and cash is decreasing, that is why we credited, okay? Now you have to make sure after 1 month how much of the total supplies purchase used during our accounting period, which is 1 month. So look here, dear students, that is $400. It's mean, so you can say now our expense increased, so supplies expense debit and supplies credited. How much? $400 to be debited and $400 to be credited. Okay, dear students, it's easy. So now why we are debiting supplies expense? Because it is an expense, and increase in expense should be debited, right? And here we are decreasing the supplies, we are crediting it. Why? Because it is used. How much? $400. So look, dear students, you have learned how to convert the current asset like supplies into the assets, okay? Now we are coming into another example. We have for example here rent paid for 3 months in advance. Okay, you have a business and you have paid rent. How much? $900, but in advance, right? For how much time? 3 months. Dear students, keep in mind, if you have paid anything in advance, like you have paid rent, or you have paid insurance or salaries or anything you paid in advance, so we are debiting the prepaid rent or bill or insurance, whatever that is, right? Why? Because all prepaids are our current assets. So look here, in this example we are debiting prepaid rent and we are crediting cash. How much is prepaid rent? $900. And how much is cash? $900. So dear students, look here. Why prepaid rent debited? Because it is a current asset and it increased, and cash credited because asset decreased. So keep in mind, all prepaids are our current assets. And what is the definition of current the assets? Anything which the benefit is expected from. So the prepaid rent is just giving us some benefit in the future. Okay, now another transaction, we have furniture purchase for cash $5,000. So here we are debiting furniture and we are crediting cash. How much furniture debited? $5,000. And how much cash credited here? $5,000. Okay, why we are crediting and debiting here? Okay, furniture debited because here is increase in a fixed asset, right? And here we have decrease in a cash current asset. So look here, dear students, you have learned in this example we have recorded the first general journal entries. Now we are recording their adjusting entries. Okay, so dear students, what are adjusting entries? Adjusting entries are those entries which are required to be recorded at the end of accounting period. Now you think about it. Does the first entry is having any adjusting entry? You should think about it. Yes. Why? Because you have paid the rent in advance for 3 months. So you debited the prepaid rent. Now, after 1 month, it means you have used the prepaid rent. So you have received the benefit. Now we can say if the 900 is for 3 months, then the 1 month cost of the rent is how much? That is 300. So you can say the 300 out of $900 we have used. So that expense. So what you should do, you have to debit expense account, and that is rent expense account, and you should credit prepaid rent account. How much? $300 and also $300. Dear students, why we are debiting the rent expense? Because expense incurred. Obviously 1 month we have taken a benefit of what? Here we are not paying the cash. Here we have an asset and the value of that asset decrease, and that is which asset? Prepaid rent. Now we are apportioning out of prepaid rent how much converted into expenses, so we can say $300. Now we come into the second transaction, which is furniture purchase. Think about it. Not only we are converting the current asset into expenses, but also the fixed asset. So if you have purchased the furniture at the beginning of the January, now after 1 month, think about it, how much furniture converted into expenses. Why? Because the furniture definitely is used in a business. So when you use it, so its value is decreasing. Now we are just looking here, using straight line method, monthly depreciation of furniture estimated how much? $50. Maybe the furniture is having a useful life of 20 year or 25 year or more, but it is given how much it is depreciated in January, and that is $50. So it's been the amount of $50, the value of furniture decreased. So we say what is debited here? Depreciation account debited, and accumulated depreciation of furniture account credited. How much? $50. Dear students, try not to be confused. Why here we are recording this transaction a little bit differently. For fixed asset, we always debit depreciation. Why? If you have building, equipments, computers, machines, or whatever, so when they are used, so we say depreciation account is debited. So this is only for fixed asset, okay? And then what is credited? Accumulated depreciation of furniture. So if it is building, then we are crediting accumulated depreciation of building, or if it is computer, accumulated depreciation of computer, accumulated depreciation of machine, and whatever that can be. But keep in mind, this is only for fixed asset. For current assets like supplies, as you have seen here, right? It's different. For supplies, if we have supplies and they are used, then we are not debiting depreciation. We are only debiting supplies expense and crediting the name of supplies. And similarly, we are debiting the rent expense here, as you see, and we are crediting the name of the prepaid rent. This is for current asset, but for the fixed asset, we have a little bit different rule. We are debiting depreciation account and we are crediting accumulated depreciation of furniture. But here is a question. What is depreciation? Depreciation is actually an expense account, right? So that increase we debited. And what is accumulated depreciation of furniture? Accumulated depreciation of furniture is the contra asset account, and the contra asset account is having the opposite rule of the main asset account. For example, if increase in asset is debited, then increase in the accumulated depreciation is credited. So why increase in the accumulated depreciation is credited? Because increase in the accumulated depreciation is by the meaning of decreasing in the value of the asset. So as decreases in the value of the asset is credited, so that's why increases in the accumulated depreciation of account should be also credited. Okay, so this accumulated depreciation of furniture account value, we are subtracting it from the main asset account in the balance sheet. So you have learned here that how to convert the current assets into the expenses and also the fixed asset into the expenses. And this was the first type of adjusting entry, and that is what? Converting assets to expenses. Now we are going into the second type of adjusting entries. Okay, dear students, look here. In the second type, we have entries to apportion unearned revenue or converting liabilities to revenues. We have here converting liabilities to revenue. Simply keep in mind, sometimes businesses receive cash in advance for the services to be rendered or provided in the future. So the cash received in advance is not a revenue of business. You know why? Because the business should debit cash and credit not a revenue. So what should be credited? Liability account. Why? Because when you receive cash in advance for services to be given in a future, then you cannot treat this cash as a revenue of you, because you have not yet provided the services. Once you provide the services, then you should convert those liabilities into the revenues. So look here, dear students, we have an example here. Received cash in advance $15,000 for services to be rendered in 3 months. So here is a business in receiving $15,000 for what? To provide services in coming 3 months. Now the cash which is received here, $15,000, should be debited. Why? Because it is increased in cash asset. So cash debited, how much? $15,000. What should be credited? Revenue? No, never. So we have an account by the name of unearned service revenue account, and that is $15,000. So keep in mind the title can be changed. If it is sale, so you can say unearned sale revenue account. If it is rent revenue, you can say unearned rent revenue account. So what so what is this unearned service revenue account? We treat this account as liability. Why? Because we receive cash here, but we have not yet provided the services. So we say we increase the cash, and we have received here, we increase the liability here. Clear? Now after 1 month, you should think about it that you have provided the services. So you receive $15,000. Out of $15,000, you have provided the services of 1 month. Then we say unearned service revenue account debited, and what is credited? Service revenue account credited. So how much? $5,000. Dear students, why we are debiting here the unearned service revenue account? Because it is once you are providing, it means the total service to be provided for 3 months, and the value and the cost of the services of 1 month is $5,000. Then here the company has provided, right, the services for 1 month. It's mean now the company can claim that out of 15,000 liabilities recorded in the beginning, 5,000 converted into the revenue. And that is the second type of accounting, converting liabilities to revenues. Now we have another example here, and that is about January 1st, Salam University collected students' semester fee in advance $9,000. So look here, Salam University is collecting the student fee, right? The student fee is a revenue for Salam University, okay? Now Salam University should debit what? Cash. Because the cash account is increasing. How much? $90,000. And what should be credited? Revenue? No. Why? Because at the beginning of the semester, Salam University has not yet provided any service to the students. So unearned fee revenue account should be credited. How much? $90,000. So Salam University should treat this $90,000 as a liability of Salam University, not as a revenue. But after 1 month, when Salam University is providing services for 1 month, then Salam University should think about it. In $90,000 liabilities, how much converted into the revenue? Simply, so we should debit unearned fee revenue account. How much? Equal sign 90,000 divided by 6. So it's been $15,000. Salam University should debit, right, unearned fee revenue account $15,000 because the liability decreased for this much amount. And what should be credited? Yes, the fee revenue account of Salam University for $15,000. So dear students, look here. After 1 month, you can say Salam University is providing the services to the students. So in $90,000 now Salam University can claim that $15,000 converted into the revenues. So dear students, you have learned the second type of adjusting entries, and that was converting liabilities to revenues. I hope you have learned, and for the coming 2 types we will discuss them in coming lecture. So wish you good luck.